Hello, everybody. Thank you for joining us today. I am Ilan Handelsman, National Sales Manager of Raintree Financial Solutions, and I am thrilled to be joined today by the guys from MakeSpace, Danny Friedman and John Manley. They're going to walk us through their presentation, and then we'll open up for Q&A at the end. Please, at the bottom of your screen, click on the Q&A icon and type in all your questions there. I look forward to reading them out at the end. And gentlemen, over to you right now.
Thanks very much, Ilan, and welcome everybody. Glad you're here. Thanks for carving some time out today. And obviously we have Danny Friedman on board. Danny is co-owner of MakeSpace Inc., MakeSpace Capital Partners, and is also Director of Business Development. And my name is John Manley, and I'm responsible for business development in the capital markets. And for anybody that's brand new to this, I just sort of want to give you a high-level overview before we get started of what MakeSpace Capital Partners is all about. So what we are is a private fund that's open to retail, accredited, and institutional investors. We're building a portfolio of self-storage assets across Canada. Portfolio is looking to build out to about 15 to 20 facilities across Canada. And we're well along that way. We're sort of ahead of schedule with respect to acquisitions and capital raise and that sort of thing. So lots of exciting stuff happening right now, and we're anxious to share this info with you. So let's get started. All right, listen, I'm just going to stop my video to give us a little more bandwidth here. Bear with me 1 second. All right, that clears up our real estate a little bit. So listen, what are you going to learn today? What's kind of the takeaway at the end of this session for you? So we're going to give you an overview of the self-storage industry in Canada and what makes it and MakeSpace Capital Partners particularly attractive to investors. It's a dynamic space that's growing rapidly, and we're going to show you how that puzzle fits together. And then, of course, we're going to talk about the MakeSpace Capital Partners' unique value proposition. I mean, why invest with us at all? How do we stand out from other real estate or storage investments in Canada? And then we're going to look at how MakeSpace Capital Partners is positioned for continued growth into 2021. And we've got a lot of exciting stuff coming up, so anxious to share that with you. And then, of course, we're going to give you the details of the MakeSpace Capital Partners offering and see if that perhaps is a good fit for yourself or your clients going forward with your financial picture. All right. Bear with me. Just click on there. Okay, we got it going again. All right, so as you know that with any business opportunity, it always starts with solving a problem. And by solving a problem, we're making life better for somebody else, either our customers or our investors, or of course, both. So number one, of course, is demand. You know, without demand, there's no business anywhere. So as we looked at the self-storage space in Canada and how that may grow out going forward, what we saw was that there was a tremendous demand opportunity in Canada. So lots of room for upside, lots of room for growth. And if we compare that or contrast that to what's happening in the United States, there's approximately 8.5 to 9 square feet of storage space available per capita there. So a mature market down there, but still a very robust, dynamic, and profitable business in the United States. But Canada is sort of being looked at as the emerging market of self-storage in North America. So it presents tremendous opportunity. And then problem number two, and it's not really a problem, but sort of a perspective shift, is that in Canada, 80% of the market is still fragmented. And that really lends the opportunity for consolidation and building the portfolios as we're doing with MakeSpace. So with 80% of the market fragmented, that simply means that it's owned by single operators, mom and pop operators, and it lends the opportunity to build a portfolio, build a brand about it, package that up, and potentially sell it to a larger player. And that's a big part of our plan moving forward. And of course, number three is that in Canada, investors were kind of shut out from participating passively in the self-storage space in Canada. I mean, of course, yes, you can get into multifamily, you can get into office and retail. I mean, throughout this pandemic and recession that we've been in, those areas of the commercial real estate space have been volatile. They've suffered, there's no doubt about it. And one thing that Danny's going to sort of highlight as we go through our presentation is some of the metrics on how self-storage has performed during this recession. And we've always kind of talked about that point, that self-storage is a recession-resistant business. And it's really, really proven itself out in this really volatile economic environment we've been going through over the last year. And as I said, Danny has some great metrics to share with you. So now here's an opportunity for investors now to participate passively into the self-storage space in Canada. So with those three problems kind of outlined, what was the solution? So Danny and Vaughn, as they looked forward, they said, hey, listen, what if we could build this portfolio of self-storage properties in diverse markets across Canada? Let's set a target of 15 to 20 self-storage investments. Let's build a brand around it to really help, drive operational efficiencies, bring costs down, get that goodwill value of branding, which has a dollar value attached to it itself. And we're really fortunate to have internally a state-of-the-art property management and operationals, our operational department, with a great team heading that up. And they're able to look at real-time metrics and really, zig and zag as demand fluctuates and as the market is dynamic and things are changing, we can respond to that very, very quickly. So having that portfolio objective in place and the branding in place really sets us up for success. And then of course, number two is, why not give our investors the ability to participate immediately in cash flows? So with that, only stabilized properties are coming into the fund. That means that they got a bottom line, they're throwing off enough cash flow to support our right now targeted 6% annual yield. And that is paid out quarterly to investors, either in a DRIP or cash format, but currently is a targeted 6% yield, and that's being supported by our capital and the cash flow from our current properties in the fund. And then of course, with any real estate project, we're looking for capital appreciation and a liquidity event and an exit date. So with the storage properties that we're acquiring, the hope is, of course, that they're going to appreciate over time in a couple of ways, and just natural price appreciation, and of course, in the pay down of debt for principal build there also. And then, what are our exit options as we look to exit? And we have a number of those in place. We could be sold to a larger fund, a public REIT, potentially be rolled into a larger new MakeSpace Capital Partners fund. We've already had institutional interest from a variety of players, and talks are ongoing, but right now we sort of scheduled our exit for midsummer 2025. All right, so I kind of wanted to highlight this performance screen because I think it's really, really important, because there's a couple of two key takeaways. And as you know, as advisors and investors with any investment, you'd like to have a low volatility of returns, and you'd like to have a high absolute return also. And self-storage over a very long period of time. Now, this particular chart covers the period from 1994 to 2017. But what it's sort of highlighting here is that self-storage had a 41% higher ROI and a 35% lower volatility ratio. That simply means the volatility of returns. And comparing that with other investment opportunities in the commercial and industrial real estate space. All right. So, and Danny, I know you're online there, and I don't want to hog all the space here. If as we're going through our presentation, and I'm going to bring you in naturally anyways, but if you want to add any color, just interrupt me and pipe in there, okay?
Thanks, John. And just to point out on that, if you go back one slide, the storage industry, part of the reason it's so resilient is just that there's different drivers in the market depending on where the market's at. In a highly, in a real positive economic part of the cycle, and so that will drive a little bit of business or significant amount of business to the self-storages. But even in the downturn, now there's still movement in terms of people in the world, I guess, for lack of a better term. There's people moving back home and they can't really sell their stuff, so they put it in storage. One thing that happened is places like restaurants could only go to, half or quarter capacity, so they needed a place to store their tables and chairs. There's different drivers in different markets, and that's a big part of what creates the returns.
Great color. Thanks, Danny.
Yeah.
All right, so what's going to, support this business going forward? I kind of say we're in the second inning of this ball game, and there's a couple of key factors. Number one is, Canadian population growth. As we look at this chart, if we kind of look at the median growth scenario over the next number of years, this kind of goes out to 2063. By 2050, Canada's looking at adding another 5 to 7 million people to our population. And as you all know, Canada's a young country. It's not even 200 years old yet. We have a huge land mass, as you know, and wonderful natural resources. I live in the GTA area, and I can tell you flat out over the last 20, 30 years, the growth here has just been exponential, and it just continues to build out. As we look at immigration numbers coming into Canada, we have approximately 300,000 on average new citizens coming to Canada on an annual basis. That's a medium-sized city being born every single year in Canada. And the majority of those folks are coming to Ontario, and they're going to BC. That's where they're landing. And Danny and I had looked at a report just recently from Colliers, I believe, and it basically said in the GTA area alone, going forward over the next 10 years, we can support another 100,000 square foot storage facilities just to meet ongoing demand going forward. So that's why I kind of say we're in the second inning of this game. There's a long runway ahead, and that's very exciting. I know Danny and Vaughn are in this for the long term. They've been in this business already for 10 to 15 years, but they see that runway ahead and want to build this out and participate in that growth in a meaningful way going forward.
I think, John, one of the fascinating trends from the pandemic was the people sort of discovered they didn't have to go into their downtown office, and they also didn't really like being on the 17th floor of their apartment building. So there was a bit of a move out of the main centers into the outlying communities. We saw that in and around Vancouver and Toronto. And actually, for the first time, I read just a few days ago that Toronto and Vancouver populations actually decreased for the first time, in recent memory. And at the same time, what happened was we sort of stopped immigration because of the pandemic. So there's no influx. So it's just it's kind of interesting trend that happened. And what will likely happen is we'll still see a certain percentage of that population go to those sort of other centers, which is more typical of our type of self-storage that we're building. And then immigration will turn back on, and you'll see the city centers grow again. But just a sort of a fascinating dynamic that happened in terms of population and movement in Canada.
Yeah, exactly. There's a huge shift happening right now because of what happened over the last year. But as Danny said, right now it's kind of a small part of the picture. As things sort of normalize and get back to our regular routine, which we will over the next little while. It may take a little while, but Canada's a young country. It continues to grow. I just wanted to kind of share a couple of quotes here, just sort of backing up what we sort of just talked about a minute ago. Okay, so let's take a quick look at the business model. And, very simple. We're building that portfolio of stabilized storage investments across Canada, supporting that 6% annual yield, gets paid out to investors on an annual basis so they can participate. Some folks need yield. As you know, we're in a very, very low interest rate environment, zero bound, anticipated to stay there for the foreseeable future. And so investors are still hungry for yield. Some of them need yield just to support their lifestyle on an annual basis. And this makes this investment very attractive. And then eventually a portfolio sale. And with that, through our modeling, we've anticipated and looking at targeting a 12 to 50% total annual target return on exit. And that equates to about a 77 to 101% return on capital over a 5-year period. So a very healthy and robust business model that is a great benefit to investors alike. And if we kind of look at this graph down below here, just want to highlight something that's very unique to MakeSpace Capital Partners, and that's our 3 revenue streams. So as you know, that with any real estate development project, you get that dip in the beginning there, when there's really no revenue coming in, the land is being dug up, buildings are being built. Eventually, it gets leased up and sold. And for us, it's the the fixed storage business. Those are the big lockers and buildings that you see along the side of highways, and that's a wonderful business. But as you know, there's a limitation with that, because once those lockers are filled up, the revenue is sort of capped off. There's really nowhere to go other than incremental rent increases over time. But Danny and Vaughn looked at it and said, hey, listen, what if we could add on our expertise in portable storage and flex storage on top of that? What if we could bolt those 2 businesses on? That would really take the ceiling off of our revenue capabilities. So, and that's been playing out. Our portable storage business is, as you know, containers. And with that, we lease those out to our customers, and they can keep them on their sites, or they can bring them back to our land and facilities and store them there and stack them there. It doesn't cost us any more to have them stored there. And so what happens though is that the top line revenue really jumps, and that means net operating income jumps also with incremental costs. There's really not a jump in cost there at all. And then on top of that is our more robust and dynamic flex storage business, where a customer may call us and say, listen, come and pick up our inventory, bring it back to your facility, store it for us. We'll give you a call and bring it back to us. So we're integrating our tire storage business into our portfolios also, which is a dynamic and robust business. Danny, do you want to add any color into the business model at all?
I think you pretty much covered it, John. Like they do add a lot of value post stabilization. The fact that people get to come in and their money's going to work right away, I think is really positive. And the portable and flex storage drive continuous growth. And as we go through the presentation, I have a few sort of examples of that type of growth that's been driven into each of the facilities.
Excellent. Thanks, Danny. Okay, so listen, what's coming up for MakeSpace Capital Partners in 2021? So very happy to announce that we just completed our January close, largest close on record. We brought in 2.7 million, and we really saw that capital raise start to ramp up going into Q4 in 2020. But just super, I guess, grateful for the confidence that investors are showing in the business model, and kudos to Dan and Danny and Vaughn and the team. And being able to execute in a very, very difficult environment. And investors are picking up on that and seeing that we can get things done and things are moving forward. There's a lot of momentum happening there. So our A2 series, which is an 80-20 split in favor of the investors, is coming to a close with our March close. And after that, we're going to the A3 series, which is our 75-25 split in favor of the investors. And then also, we have a mini portfolio scheduled to come into, anticipated to come into the fund in March of 2021. And we're expecting the NAV to change also with our financials that are going to be completed in March. And Danny, I'll let you add a little color onto that also.
Well, first of all, like, we are grateful for the money that we closed on and do continue to see momentum. And honestly, we're not alone. The storage industry has seen a lot of money flood into it. I think Bill Gates just invested heavily in StorageMart, a big US REIT. We've seen lots of funds flowing towards self-storage because it's just performed exceptionally well during this pandemic. The A2 series, very popular. The Kitchener mini portfolio. Kitchener is the second fastest growing city in Canada. It's a great market for us. That portfolio should perform exceptionally well. And yeah, we will reevaluate the NAV with our financials coming in March, and then reevaluate quarterly after that. And I'm excited to see what the results of that are.
Excellent. Thank you, Danny. Okay, so we're going to take a look at the properties in the fund now. Danny's going to provide a little color on that. But the first 2 properties were acquired in 2019. That was in Winnipeg and Pender Harbor, BC.
So,
So,
oh, sorry.
I'm sorry. Go ahead, Danny. I was going to let you.
I'll just pop in here. So we actually bought Winnipeg in 2015 and sold it to the fund in 2019. Winnipeg facility is a nice facility. There's 3 buildings. There's parking. It's actually been developed a little bit more than it is on this picture from Google Earth. You have that bottom part there that's green is all paved now, or sorry, graveled, and it's got additional parking as well as some container storage. And then off to the right to the tree line there, well, a bit of that has been developed for our tire storage, but also there's some ag land there that we're talking to the province about rezoning that came in with the property. You'll notice that this facility is along the highway. You know, in self-storage, there's 2 ways to attract customers. One is they drive by and see you, and the other one is online. You can look at our online marketing. I think it's exceptional now, but all of our facilities are in high traffic zones. And when I talked about the NOI growth and the growth due to portables and additional parking in the case of Winnipeg, and ideally this year we're able to add another building of heated and some additional container growth and flex storage. But from 2019 to 2020, we saw an NOI jump of 375 grand to 417 grand. And the implied valuation at the same cap rate is from a 5.25 million to 5.95 million. And that's after it's been stabilized. Like, that's from a stabilized property. It's incredible growth. You know, just on a unit basis, we've grown Winnipeg year over year, and this is stats from this week. We have 87 more units available in Winnipeg, and even with those additional units, we've grown occupancy from 83 to 87%. So it's been a great win for us and for the partnership.
Yeah, it's amazing metrics in this environment just to see that with the added capacity and still occupancy is growing. Thanks, Danny. Let's take a look at Pender Harbor. What a beautiful setting.
Yeah, so Pender Harbor is beautiful. This is a legacy property. My partner Vaughn built it in 2004. This is where he sort of started out and built his container business from here as well. But it's a beautiful area of BC. You can see it's a sort of substantial buildings on the side of the mountain there. Again, this is a property that's been owned since 2004. It's been stabilized for quite a few years, but we continue to grow it. In 2019, we grew the NOI from 365,000 to 418,000. Implied valuation from the same cap rate of 4.97 million. That's what the partnership bought it for. And based on the 418,000 NOI, you would see a $5.8 million valuation. It's great growth in a year and a half. Now there is a tuck-in acquisition in Pender where we bought some portables. Our flex growth is 100%, and actually same metrics that I used for Winnipeg. We've had a 60 unit growth year over year, and have gone from 69 to 83% occupancy. And we continue to have great occupancy. This is actually a very unique year. Typically at this time of year, we would start seeing occupancy drop a little bit because people's summer and spring projects will have ended and some of the containers would come back. But this year in the pandemic just continues to drive growth, and people are holding those for a longer period of time. And so we're still seeing, 87% occupancy is fantastic for this time of year.
Right. Thank you.
Yeah.
Okay, so we're going to shift over to storage assets acquired in Prince George, BC in August 2020. And these properties added another 130,000 square feet of rentable storage space and an additional 1.584 million top line revenue projected for 2020. We'll have those financials updated fairly soon. And MakeSpace Capital Partners controls about 60% of the available storage space in Prince George. And this is where they're located. And Danny, I'll let you sort of take that away and talk about those properties individually.
We're super excited about Prince George. I'm glad that we were able to get it into the partnership this year. You're seeing 4 locations in Prince George. 2 of them are self-storages that have been there for a while. They're at 90% plus occupancy, representing great cash flow. And actually there's some price appreciation that's been going on in Prince George, driving further returns. And then at the top, you see MakeSpace Heartway Drive, which is our development property there. We built 10,000 square feet last year and leased it up in 5 months. And actually, because of the pandemic, the city was kind of shut down with regards to their development permits. So we weren't able to, we want to build another 20,000 square feet, but weren't able to, but we were able to place another 38 shipping containers on site that are over 90% leased up as well. And now we're in a DP process with the city to build another 20,000 square feet. It's going to be a great boon for the partnership. Our modeling shows, and there's the difference between reality and modeling. Like, it's got to play out, but assuming that Prince George continues to be a good market for us, which all indications in Prince George are. In fact, in 2019, they had a record growth for their development permits, both in volume of permits as well as dollar volume. If that continues, this should be, grow to be worth about, our portfolio there at about 18.7 million, which is, again, nice growth for the partnership over the next couple of years.
Excellent, thank you. Okay, so just wanted to take a quick look at the assets, some aerial views there. Once again, just to show that they're along busy thoroughfares, which is just wonderful natural advertising. And then, of course, Danny was alluding to the metrics on each one of these facilities. They're pretty well filled to the rafters. And then our development project below, and Danny's going to speak to this in just a second about the build out there. Danny, do you want to take that?
Sure. You can see we sort of built the first 2 rows there, 1 and 2. We're actually going to build another 4 rather than 2. And then those containers that were initially designed to be in the middle there are actually going towards the top. We have full schematics. We do a full feasibility report. We know the demand of Prince George. It's a high demand area for storage, and all the extra demand is being soaked up by our development property. So again, we own 60% of the storage in Prince George, and the city itself is doing well, and our storages are doing as well, better than expected.
Excellent, thank you. All right, so we're going to sort of shift. I know there's a lot of numbers on the screen, but I just want to sort of walk through this for you, just to show you the growth picture, the line of sight, to sort of round out the portfolio. So right now, there's 5 assets in the fund, which is Winnipeg, Pender Harbor, and then Prince George, which brings us to about 25% of our goal, and a net operating income of about 1.6 million. Going forward with the development assets that we talked about with respect to the Kitchener mini portfolio, Danny may talk a little bit about other development projects that may come into the fund later on in the year. But that is looking to add another 6 to 8 properties into the fund to bring us to 11 to 14 properties total, and a line of sight of about 75% of our goal, and a targeted net operating income of about 5.6 million. And then Vaughn is currently on the hunt for off-market acquisitions. He's traveling around the country making deals as we speak. And even with that, that would add another 3 to 4 facilities, bringing us to a total of 14 to 18 properties, and 100% of our goal for the fund, and a targeted 6.6 million in NOI. Danny, any color on this before we move on?
I would say, like, I'm looking at this slide now, John, and this is a slide we built a couple months ago to reflect Kitchener and other properties that we have. I would say we probably have line of sight on almost 100% of the acquisitions that we need, that we should be able to accomplish over the course of the next year and a half. It looks like Kitchener's coming in next. We have an opportunity on Vancouver Island. We have some facilities there that I think will come in as a portfolio as well, in Alberta as well. It feels like I mean, I'd have to get to the numbers exactly, but I think we're close to 100% of our goal. We should have no problem filling this fund, assuming we can raise the capital. And even if we didn't raise the capital, we could cut it off at any time too. And we already have a portfolio. We already can see the value that we've created in the facilities that we've already got in the fund. So it's pretty exciting times. Yeah.
Yeah. Excellent. Thanks, Danny. All right. So we wanted to run through a couple of different modeling scenarios, and just a little caveat with this. These are forward-looking models, but based on the metrics we're going to present here, this should how it round out as we look to exit the fund. So currently, we're looking at, on this particular base model, a 4% annual growth rate, and then acquisition cap rate average about 6.75, and then an exit cap rate of about 6. And just knowing the market and what we're seeing in the market now, and of course this could change over the years, but average cap rates are down around 5.5% right now. So that would imply a pretty decent multiple going forward. And the standard loan to value of about 60%, and Danny will speak to this, I believe we're a little less than that, an average debt rate of about 3.75 on the borrowings. But with that, at A2 series, the annual IRR on exit, and this is targeted, 2025, would round out to about 16.2% annually on the A2 series. The A3 series, which is coming up, would be about a 12.7% return. And the A4 series, the last series, would be an average about 10.9% on an annual basis. Danny, before we move to the next scenario, anything you'd like to say on that?
Just like the 4% annual return is very achievable. We do that. We budget for about a 6% annual return, and we've been pretty good at hitting our budget. So I don't see that as something that would be a challenge. Acquisition cap rate, again, I think we're well within the range there, and I think the exit cap is conservative compared to what's in the market right now. So it feels like this is a very realistic picture of how I think we're going to perform.
Excellent. Thank you. So with that, we wanted to sort of look at an upside scenario and a downside scenario. We'll look at that in a second also, but let's just say we were able to maintain our 4% annual growth rate, but able to exit at a 5.5 cap. So that brings the A2 series up to 19.8, the A3 series, up to 15.9, and the A4 series at 13.5% on an annual basis. And this represents the annual change from the base case scenario. 3.6% on the A2, 3.2 on the A3, and A4 is a boost of 2.6%. So wanting to be the devil's advocate, let's look at
just before you go there, John, I would just say that, we're part of why we modeled this and wanted to show the upside is we are seeing a lot of funds flow into the storage space, a lot of demand for storage. And that does drive down cap rates. And that's what we're seeing in the market right now. Cap rates are down probably a percentage point from, maybe 3 years ago. And we're continuing to see more money flood into it. So it's a great time to buy and a great time to hold for a little while to see that continued cap rate compression. That's how it feels from my side. Again, the world, as we've seen, can shift in many different directions, but I believe that this is becoming a more mainstream asset, and what we're seeing in the market is a lot more capital driving towards it. Yeah. And then that creates the cap compression.
Thanks, Danny. Okay, so let's look at a downside scenario. We brought the growth rate down a little bit to 3% and boosted the exit cap rate up to 6.25. How does that affect the A2 series? So it brings it to an annual IRR of 11.7%. The A3 series annual IRR at 10.3, and A4 annual IRR at 9.6. And from the base case scenario, that brings it down 4.5% on the A2, 2.4% on the A3, and 0.4% on the A4. Anything on this before we leave, Danny?
I'd just say, like, Vaughn and I have a sort of saying that we throw back and forth to each other when we're making sort of these types of investments, and it's heads I win, tails I don't lose too much. And that's how this feels. It's like, okay, well, if things don't pan out exactly how we want, and we don't get the cap rate compression we want, we don't get the growth rate we think, or we're able to achieve now, then we're still driving a 12% return, and that's in this market that feels really good to me.
Yeah, that type of double-digit return in this ultra-low interest rate environment is very attractive. Okay, so what are our exit options? So as we talked about earlier, a sale to a large storage operator. Storage Vault has not made it any secret at all that they'd like to own pretty well all the storage business in Canada. Not saying that we're going to sell to them. We have plenty of options, but they are on an aggressive acquisition path. We've had discussions about creating our own public vehicle. That is also an option for us. And as Danny had alluded to, we've already had institutional investor interest in the fund as it is now. But looking at that long runway, we still see plenty of upside there. And then the idea of selling to a larger MakeSpace fund. Danny and Vaughn are both in this business for the long run, and they love the space. They see the growth opportunities ahead, and there's no reason to fill up this fund and exit in 2025 and just call it a day. There's plenty of growth beyond that. Danny, anything you'd like to add?
No, I think like all of them still feel very viable. And in fact, we've been approached about creating a public vehicle. We've, as you said, been approached by a few institutional investors. What you just said, you know, Vaughn and I are we both love storage. There's so much value created in this business, and it's long-term value, and both of us like that. And so the idea of creating another larger fund to roll into is attractive to us. And all of them have the same game plan, which is acquire the assets, stabilize them, grow them, and continue to grow them. And then, you know, the sort of money will follow later. So I'm not too worried about the exit. There's lots of options, and the game plan is get that growth in that scale. That's what we're doing.
Wonderful. Thanks, Danny.
Yeah.
Okay, let's take a quick look at the team, and we've referenced Vaughn Koyeman several times. So he's the founder. He's the head of acquisitions for MakeSpace Inc., the parent company, for acquisitions, looking to build out the fund. But he brings a wonderful wealth of experience to the team. You know, 15 years of experience in self-storage, portable storage, container leasing, and sales. And he's a driving force between him and Danny, you know, pushing this needle forward. And of course, Danny Friedman, I get to work with him every day. It's a great honor and a privilege. And he's a gentleman that, you know, eats, breathes, and sleeps this business. It's on his mind 24/7 and constantly pushing that needle forward also. But brings a wonderful wealth of experience in business development. I mean, prior to coming on board with Vaughn, he was in the corporate FX business, and, you know, took a small desk and helped to build that out to 15 different locations around the world. So he's not shy to get on the phone and break new ground and get people and share his vision and his idea and get other people excited about it. So I'm always super excited to work with Danny every day. And then Terry Thomas, our CEO, you know, just brings an amazing wealth of experience to the table. He's the glue that holds, you know, 15, 16 different companies together. But he sort of, you know, got that experience, you know, working for such big brands as Coca-Cola, Hudson's Bay, First Credit Union. Lots of experience in real estate acquisitions, supply chain management. And, you know, Terry's a real visionary also. He's someone that's always looking out over the horizon. And he's really proven that out over the last year, and how he handled, you know, our company with respect to, you know, when this pandemic hit, and how he was able to regroup and reorganize and bring everybody together under one roof and develop a plan to navigate these really choppy waters. So just a very, very strong bench, a very strong team that I think is probably the most important thing for any business. It's not just the products or services. It's the ability to execute and to be organized and run the business. And of course, we have Joe Friedman, our chairman of the board, and that's, you know, Danny's brother. But man, what a wonderful wealth of experience he brings to the table also as a former senior vice chair of Brookfield Asset Management Company. You know, he was responsible for their strategic initiatives and planning. But brings a tremendous value to the table. He's heavily invested personally into the partnership and the fund, has a vested interest in seeing everybody be successful. And then Reed Carter, also from Brookfield, but just brings a wealth of experience on different boards and oversight, planning, consulting, that sort of thing. Danny, any color on the team before we move on?
I would just say that, like, a lot of what I really like about the way our team runs right now is that everybody's in the right seat. Vaughn is a great driver for acquisitions. He really knows the business, has a keen understanding of what we're looking for. Terry operates like really efficiently, you know, something that I could stew on for hours and days. Terry makes a split decision, and it's the right decision, and, you know, implements it, and, you know, has done quite a terrific job taking us from a small to a medium-sized company. I feel like I'm in the right spot talking to people with some passion around MakeSpace. I believe in it, and I believe I can communicate that. It just feels like the right people are in the right seat and able to succeed where they're at.
Yeah. Thanks, Danny. All very important attributes. So we're going to wrap things up here fairly shortly. We'll look at the offering, but just want to sort of recap, what's the MakeSpace unique value proposition? What makes us stand out? And as we just talked about, management experience and alignment, that 15 years of experience and that deep bench really helps drive the execution. And of course, all the management team maintains their own current investment stake in the partnership. So that alignment, I think, is very important for any investment. If you're asking investors to plunk down their hard-earned dollars, you want to make sure the management team's doing the same thing. And then, to grow any fund like this, you need a source of acquisition. So having our development pipeline greatly contributes to us being able to confidently know that we can build out this portfolio. And as Danny talked about just earlier, we have line of sight on 100% of this particular fund already. So very confident that we're going to build out and round out this fund and put a very attractive portfolio together. And then, as we talked about earlier too, a strong downside protection, that natural hedge that comes into play in recessionary environments where self-storage has really proven itself to play out as we've seen those metrics maintain and grow throughout this current volatile environment that we're in. And then cash flow. Everybody wants cash flow and needs cash flow. It's so important these days. Interest rates are ultra low. They're going to stay that way for a while. Here's an opportunity for a nice, healthy distribution on an annual basis, and then potentially a very healthy double-digit payout on exit. So let's take a quick look at the offer once again. So we're looking to raise $30 million with this particular fund. We're just a little north of 10 million on that now. And as we talked about, throwing off a currently targeted 6% annual yield paid out quarterly. Just to reiterate that we're modeling a 12 to 50 total targeted annual return. And that equates to a 77 to 101% return on capital over a 5-year period. First exit date, we're looking midsummer 2025. We do have the opportunity for 2 potential 12-month extensions should market conditions warrant at that time. But having said that, as we're on track right now for 2025. And we just talked about we're wrapping up the A2 series. There is still some time to get into the A2 series. That will close out with our March close, which I believe is around March 17th. And that's an 80-20 split in favor of the investors. And that's after an 8% hurdle. And that 8% hurdle simply means that on exit, investors are made whole with 100% of their investment. And then combined with the 6% annual distribution, they get 2% bump on that to bring their annual yield up to 8%. So investors participate in the first 8% of any profits before management takes any kind of a cut whatsoever. And then after that, management is entitled to a 20% split on the A2 series. The fund has a 1.5% annual management fee. And this fund is available for registered accounts, which makes it a very attractive from a tax perspective also. So we invite you to reach out if there's any investors online, to reach out to your advisor at Raintree, talk details, and see if this is the right investment for you and your financial plans going forward. And with that pretty well wraps us up and brings us to our Q&A. I think we're right on time, which is always good. Let me just start my video back up here. Thank you, everybody. Welcome back, Alon. And yes, we'll do a Q&A if you're ready.
Gentlemen, thank you. That was an excellent presentation. Could you just end your screen share for those people that are running on one monitor?
Got it.
I have a list of questions here. Again, folks, if you have questions or comments, please type them into the Q&A chat box at the bottom of your screen, and I will get to all the questions. John and Danny, I want to start off with the 6% targeted annual distribution. What is the anticipated tax treatment of that distribution?
Yeah, so I mean, obviously the taxes in the partnership flow through. So in the first few years, we'll see return of capital. as we're starting the fund, and so we should see that for, I'm guessing, another couple of years, and then after that it'll be active income. We have a full-on portable business that, we're not a typical self-storage that sits there and waits for the business to come to us. We have a healthy amount of business that goes out and gets that business and does the delivery, the container delivery, bring it back to our site, and the tire storage as well. So we'll see active income when it's income.
So by return of capital, what you mean is that those distributions are paid out as a return of capital, and accordingly, they're not taxed in the year in which they're received. Rather, it reduces the adjusted cost base of the investment and is anticipated to be treated as a capital gain at some future point.
Exactly. Yeah.
Great. I just want to make that clear for those people on the call.
Thanks, Alon.
My pleasure. So next question, I remember one of our earliest conversations, and the conversation was around the shape of the land that you buy and the way the property taxes are assessed and paid. Mm-hmm. And, a lot of storage facilities have, rows of these like rectangular buildings. So you need a flat, pretty regular shaped piece of land to build them on. Mm-hmm. And then as fixed buildings, fixed structures, you end up paying property tax on all the square footage of the building space. Whereas what you're doing is you're combining some fixed storage with flex and portable. So the land shape can be more irregular, which allows you to buy land at a lower price. And then you're only paying tax, like building component of the tax, on a smaller square footage of the actual building. And then the containers and the portable flex storage just sits on the remaining land, sometimes the irregular portions. And this is like a micro aspect of your offering, but it shows the detail from my perspective on how you guys are really looking for all these little bits to sort of tweak it ahead a bit. Do you want to comment on that, Danny?
I would just say that's one example. And like in a presentation like this, we can only hit on so much, and we're trying to get to our key points of our business. And that's just one example of when you peel back the layers of the onion on our business, it actually gets better and better. And that's one example of that. Yeah, property taxes are a very real thing in a lot of communities and a lot of businesses. It's actually a risk to self-storage in general, because property taxes can really take off the bottom line. But we can buy unique places. We are not building the 4 or 5 story beautiful Taj Mahal self-storages in downtown Toronto and Vancouver. We are on the outskirts of the city. It's zoned appropriately for our containers, so it's got to be like a place where that's acceptable. Along the highway, a lot high traffic count. But we can have that, like in Kitchener, we have a triangle piece of land on the Highway 8 that has 50,000 cars a day going by it. And we got it at great value because of the type of land that it's on. But so our portable fleet sits there, and depending on the municipality, they might tax our containers on the site or might not. But the portables that are out there in the market, that's just like extra driving of revenues without the taxes that you would see on a building on site. It's another advantage that we seek out and enjoy as a business.
Great. Let's talk about containerization and portable storage for a moment. Containerization is a global industry in and of itself, but how do you guys get involved in logistics management and containerization, container management?
And that's how we actually got into the business. Vaughan built a self-storage and then started renting and selling containers in and around our community on the Sunshine Coast and then into Vancouver. When I joined him in 2010, we built a container wholesale business. That actually we pivoted from our main course of business in 2015 as we started advancing the self-storage. But we built it to $20 million in sales, and we probably sold 6,000 containers a year. And that was like, that had a heavy logistics component. So that is our expertise. Like, that's our original expertise, is that logistics component. For a lot of storage operators, they don't like portables. They start doing one or two, they got to hire a truck, they got to make sure it gets there, they got to like get it back, they got to clean it up, they got to put it on their land and have space on their land, all that stuff that they're not even considering. And really, until you get a fleet to 150 to 200 containers, you just don't have the scale to run it efficiently. And so we love containers. Like, we love to go out there and do that business. We know how to do that business well. So it's a huge advantage for us.
Right. So my next question is, you've indicated that there's been a bit of a flood of capital to the storage space, and there's a lot more activity on the buy side in the storage space that's resulting in some cap rate compression, which is, a function of higher competitive bidding on existing storage units. Who's your competition out in the marketplace? Like, how do you compare to, Sentinel, for example?
Yeah, so there's lots of competition in the storage industry, for sure. Canada's, like, in the States, in a few cities, you'll see that they're overbuilt a little bit. Now they have like 50,000 storages compared to 3,000 in Canada. It's like, there's a whole different market in the States compared to here. There's lots of room for competition in Canada. There's lots of room to continue to grow the storage industry. Almost all of the storages in even the secondary or tertiary markets are plus 90% full. It's like, it's a high demand. So, a company like Sentinel, as an example, that's kind of like that's a good vision for us. They built a nice portfolio. They have like some nice locations, and they also had some quite secondary and tertiary locations. And they sold to Storage Vault. They're actually owned by Storage Vault now, which is Canada's largest REIT. Like, what was implied at 4.5 cap. Like, that's a good vision for what we could do. That's a nice place to build. Now they probably got to, I think, 30 facilities or so. That's where they sold. But yeah, it's a nice company. Started, I think, in Edmonton, actually. And, from what I understand, nice couple that built that business. And, they took advantage of that run of storage in the 90s and 2000s and, 2010s. I don't know what to call that, the 10s. But for us, we don't mind competition in storage. We talk to the competition regularly. We're in conversations with Storage Vault about how to run, what to do, what they see the market doing. Another good operator out there, I think, builds the brand to the whole industry. Or want to participate in that.
Sure. Okay, that's really great. How common is it that operators are involved in the flex and portable pieces of the business?
Honestly, the flex, like, not very common. That's unique to MakeSpace. The portable may be more common, but still quite uncommon. Right. A lot of like I say, Storage Vault is Canada's biggest. They probably have 200 facilities, and they have their portable brands as well, and run them. But they're still only like, I think between them and the other sort of big players in Canada, that's only like 20% of the storages in Canada. There's lots of little operators out there in all the different pockets and towns and cities of Canada. And for a lot of them, the portables don't make any sense.
Right. And my understanding is that the flex storage, which is sort of a business-to-business relationship, that flex storage is much more logistics intensive.
Yeah.
And the example of that would be, the tire company, you go get your car tires swapped from your, your summers to your winters, and they say, hey, do you want us to hang on to your tires for you till next season? And you pay them a bit of money, they hang on to your tires, but they don't actually keep them at the dealership. They send them off to somebody who's providing this backdoor storage service. And that's you guys.
Yeah, we're the back end to a lot of those. And the same thing's happening with them that's happening in the market. Like, people are living in smaller places. People are living in, everybody likes Main Street. Everybody likes the highway frontage or the main sort of frontage building, but nobody wants to hold a warehouse there. That's like a very, very expensive proposition, right? So if they're going to carry for a lot of those dealerships, if they're going to hold the tires in their dealership or, you know, in their tire company, they're taking out a bay. Well, you make way more money out of a bay being open than storing tires. So they, you know, pay us to come on a, you know, 24-hour notice basis, and we go in, we grab the tires, we pull them back to our spot. They sit very comfortably in our buildings for 6 months or 8 months and then go back, you know, and that's a rotation we do. We have probably, you know, 400 dealerships and tire companies across the country that we service. And when we're in the location of one of our storages, they're storing at our storages. And that's drives, it's like having a great customer that consistently drives revenue to our storage, which is fantastic.
Right, and you can just add capacity by putting an extra number of containers on site to store those additional tires as they as that business grows.
Exactly. Yeah.
Great. Just jumping around here. What's the minimum investment, John?
$6,000.
$6,000 in TFSA and open investments?
Yes.
It's there to match the TFSA minimum, which is why we came up with that minimum, with that number. Right.
Okay, great. Great. Folks, again, please type in your questions into the Q&A box. We still have a couple of minutes, and I'm happy to keep asking. Danny, what difficulties have you encountered since you started, and what challenges do you foresee in the near future?
You know, our difficulties, like when we first started, it was about how many storages are there out there actually for sale, because you'd like Google on Canada storage for sale, and there was none, zero. So now with cap rate compression, more have come on the market, and we're able to find and source those. So that was probably the initial difficulty, as well as we were a storage company that wanted to grow, but we weren't, I would say, professionals at capital raising. So learning this presentation and how to meet with investors and how to process returns and all that stuff, I think that was a challenge that we had at the beginning that I think we've successfully met. What challenges do we foresee in the near future? I'm not sure, Ilan. I feel like really confident about our business. I would say, a year ago, I would have said, if there's a recession, like, are we going to perform like we did in 2008? That would be like a real question mark, but it does not feel like a question mark anymore. It feels like we know that we can perform during that recession, and we do very well. So I don't feel like nothing comes to me right away. I don't know if that's a lame answer or not, but that's where I'm at.
No, that's great. I mean, I work on the capital raising side, and sometimes organizations, businesses like yours, have difficulty raising capital at the rate that you want. Mm-hmm. And you've got a big pipeline. You could acquire all sorts of storage facilities, but you're pulling in a couple of million a month instead of, you might want 10 million next month and 10 million the following month. And 10 million the following month. Yeah. But it may not actually flow that way with $6,000 minimum investments and, a few hundred investors coming in each month.
I feel like we are at the right pace in our capital raise, and we managed the pace of acquisitions to the capital coming in.
Awesome. Gentlemen, we're at the top of the hour. I thank you very much. Everybody who's participated on this call, thank you for your time. I really appreciate all the questions that came in. Have a fantastic day. Bye for now.
Thank you, everybody. Appreciate it.